All right, everyone. I believe we'll get started. We're missing one of our more esteemed panelists, and I'm sure he'll be here shortly. I saw him just a few minutes ago. So we'll just get things kick-started. And you know, this panel is going to be discussing the goings-on within the refined products tanker market. I was very happy whenever I saw that I was going to be moderating this panel. Nicholas and I discussed beforehand, you know, all of the day's events and whatnot. And the reason why I was so happy that I was going to be moderating this panel, not only do we have some great personalities and good friends, but also, you know, I personally believe that this is probably one of the more misunderstood markets within the U.S. equity markets. My own personal take, and hopefully through the conversation this afternoon, you know, we'll be primarily talking about, you know, just supply-demand fundamentals, and then, you know, hopefully coming away with some conclusions that are productive. So anyhow, very happy to be hosting the panel, and with that, you know, kind of getting things kick-started here a little bit, and just kind of setting the stage for where we are right now before we get into some of the supply-demand issues. I guess my first question for the panel, and guys, you know, I'm hoping to keep this conversational. You know, I always approach moderating these panels like, you know, an NFL football game. If you hear too much from the official, he's not doing his job. I mean, these guys are here to see you guys. So, so I'll just throw out a topic or two, and then, you know, just chime in as you know, the urge hits you. So my first question is, you know, the products market started off, I would say, late 13 and 14, and really was starting to gather some momentum. You had, you know, Jubail come online, you had Yanbu come online, you had the Ruwais expansion, and you had, you know, quite a nice tailwind of demand that extended throughout 2015, and then 2016 hit, and things kind of started to soften a bit. So my first question, maybe for Marco, and then, like I said, just guys chime in, kind of, what happened? You know, how do we go from such a good market in 14 and 15 to a market that isn't so good today?
Thank you, Doug. I think that probably there was different things that happened. Thing number one is that market in 15 was a very strong market, but then I think all of a sudden improved suddenly when the price of oil collapsed. That increased the extreme, widened enormously refining margin. Refineries were refining everything they could put, all the crude they could put their hands on, and there was a big surge of products being shipped left, right, and center. You know, like everything, the moment that things are just refined but they're not consumed, there was not a sustainable consumption compared to what was refined. I think everything went, a lot of things went into stock, and that's starting the weak market of 16, which, you know, 16 was started on a very good note. Q1 was decent, Q2 was semi-decent, Q3 was terrible, but in Q4 we started already seeing an improvement of the market. So I think you're right a little bit that 15 was a very good market, 16 not as good as a market, but you could see also a lot of pent-up demand. Every time you had some kind of oil duct accident, prices were shooting up dramatically. You could feel that there was a demand that was contained. There was a lot of volatility. It's just that there was a lot of stock. And now we're starting to consume this stock, and I think this is not the story, but I think I'll leave it to somebody else what's happening now, I think.
Yeah, well, in addition, I mean, we've seen a lot of deliveries, new vessels coming from shipyards during the past 2 years, and that has been affecting also the market.
Gotcha. I see Kim, you leaning forward.
Yeah, because I was trying to be bold enough to say that this was going to happen already in 2015. Things were a little bit too good in a way in 2015. People were stocking up like there was no tomorrow because of the low oil prices. And when you have full inventories like you started to have, you know, from last summer, that's really when tanker market is getting hurt, because stocks are high, refinery margins are going down, arbitrages closes, and if you have arbitrages that close, you get the same ships hovering around in the same area all the time. They don't go on these long haul, nice arbitrage driven trades. So all of that came together last summer, and I remember calling it the market's going to get brutal, and it was brutal in a way. People have different definitions on the word brutal, of course, but it was bad. It was $5,000 to $10,000 a day, and that's not very good. We all made more than that, but still around the 10. So it was tough. So I'd say the inventories, and of course we had influx of ships at the same time.
Gotcha.
But
Jerry.
But I think it's also worth thinking about how things will fare going forward. And in a way, we have seen the worst is probably behind us. The bulk of the deliveries are there. Of course, 2017 is a year of high deliveries, but when you look at the order book, maybe 80% of the existing order book will be delivered this year, but after that there is very little. In addition, you have seen some drawdowns on inventories. Last week there was the largest drawdown on US gasoline inventories since 2011. Let us see whether this is going to be the way that things will evolve going forward. But if we have a situation where there are sufficient drawdowns on inventories, we see the last bit of the increased supply of ships. It's not difficult to imagine that that at the next seasonal peak, you'll see suddenly fleet utilization going up, and suddenly rates will not only improve but probably soar. So I think this is the first time I'm quite constructive on product tankers since actually 2015. So I agree with Kim. Things going forward are actually the best we have seen, not only because demand is quite strong, but because the supply is what it is.
Yeah, and that was going to be a follow-up to the first question is, and maybe for Robert and Jakob, when you look at where we are today, I mean, rates are pretty poor, asset values are fairly attractive, and so kind of hearing some of the commentary and it leads me to believe that, well, maybe the outlook isn't so poor. So, I mean, Robert, how would you describe the current asset value environment, charter environment? Is it as bad as things seem in terms of, what people can glean from those two indicators?
I'm very glad you asked me about the current and the future, because having been in New York now for 30 years, nearly 25 years, of course I have no memory. So it's all about the present and the future. Now, I actually think rates are really okay, considering what's been thrown at the product market in this last months with the last bunch of big deliveries in this first quarter, this de-stocking environment, the lack of arbitrage environment that Kim is quite rightly pointing out. It's actually pretty good. Earlier, we have people sort of diving over everything to buy dry cargo. It really doesn't matter as long as it's got a dry cargo name. And they're really ignoring the product market. But when you look at the product market on values related to earnings, it is actually doing pretty good. There's not a single, first of all, the net asset values of the companies that the analysts give are massively understated. I don't think there's a person on this table who's willing to sell one of their vessels or needs to sell one of their vessels at the values that the analysts are putting in. The balance sheets are reasonably constructive. Even in the worst of times, the product market has, given at least its operating cost, its interest, and some contribution to amortization. The rates right now that we are, and I mean we as a group here, are receiving on our spot vessels, I'm quite sure that Jakob has the same sort of hysterical laughter once a week when he sees the Platou-Clarkson's LR2 index as I do. And Kim as well. I mean, it's like, really? There's no, if we were to pay our chartering people bonuses based on their outperformance of the analyst indexes, they would have all the equity in our companies within a month. Right. So the market, I feel sorry for you guys because you're not really able to have the data to see this, but I'm very confident that the product market is the sleeper here. I'm very confident that when we come back here in a year, that some of these companies on this table would have outperformed any other shipping class between now and next year. And because of what's going on in the industry as a result of crimping of shipyard capacity, possibly continued orders in gas or other areas. The product market could be set for really a multi-year elevated and elongated real positive period.
And Jakob, kind of following up to Robert's comment just there, when you look at the underlying fundamentals, so we discussed, inventory overhang, stocks being elevated. We discussed, a lot of ships being delivered over the last 12 or 18 months. But what we haven't discussed is that global oil demand last year was 1.5 million barrels a day. And the market is, a variety of commodity markets is pricing in that things could actually even be getting better as it pertains to 2017. So my question is, how important is that to the demand fundamentals of the product tanker market, like end user demand, but then also taking it, within the product tanker market and saying, all right, so if oil demand strengthens and oil prices strengthen, what does that do to some of the refineries that have been helped along over the last couple of years by lower oil prices? So kind of two-part, the importance of oil demand at current levels, and then also the impact on refining capacity in some of the end user markets.
Okay, well, first of all, I would like to say that I agree with Robert that if this is sort of in a cyclical business that we have seen behind us, the downturn in the market where everybody's actually profitable and beating the heck out of indexes, this is really a very good business to be in, and that we are sort of now going to be discussing the future. I very much agree on that the elevated stock worldwide has been problematic for us, and we have to go through a period where we are hit by this elevated stock, which is, compared to 5-year averages, 10% higher than what we've seen. That's not a small sum on a worldwide basis, and at the same time, the new deliveries. If we take the substance of oil production and then daily oil consumption, okay, so it's going up by, let's say, 1% year on year. That's not going to satisfy actually the additional capacity coming in the product tanker space. So we do need still to see the refineries opening up, dislocated from where it is being used. That is playing out very nicely as we speak, has been ever since 2013, 14, and also this year and the coming 3-4 years. So that's happening, and that means, of course, that it's a multiplier effect. So it's positive on balance that you've got a fundamental demand growth of 1%, but it's not really the key factor. I think this industry would still, and we would all here, have more demand as we progress over the years, even in a flat environment. Oil prices, I think the other panel was pretty accurate around saying that the current oil price is constructive, between 50 and 60. I would go a bit wider and say that anywhere between $30 and $70, I actually think that consumer behavior is relatively ignorant to that, and that we would not see a spillover in lower demand and therefore lower demand for our transportation needs, even in an environment where oil prices shot up by another 20%.
Gotcha. So Kim, can you, or anyone on the panel, just kind of give us an update as far as kind of some of the latest on refinery closures? I mean, there's a while there where we were hearing a lot about refinery closures and some of the developed markets. So can you kind of maybe provide an update on any closures, or even to Jakob's last point about some of the new refineries that were planned to come online, kind of the status of some of those?
Well, as far as I know, everything is basically going as per plan. I think all the refineries that were supposed to be closed over the last 2-3 years have been closed pretty much, with a few exceptions maybe. We had, in 2016, we did still have one big refinery in the UK, one big refinery in France being shut down. And also in Japan, all these refineries there are actually decreasing their production quite a bit. So that is ongoing. So and I think that's fine. And I think the new refineries, we've seen the two big ones in Saudi. They're already in the equation, and there's the next one in Saudi is 2019. But there's one small one in Oman and so on and so forth. So I think we're continuing on that path. Western refineries basically closes down. I think they have reached a level where they are not going to close down anymore. I think that's kind of an equilibrium. And the new ones are coming on stream And all of this is good for the product tanker market. It opens up new trade lanes and all of that. So it's good.
Good. Jerry and Eddie?
Well, the only thing that I would add is that maybe 2015 was a saving grace for certain of the European refiners because simply refinery margins were too good. And that probably meant that a number of refineries that would have been put out of business earlier continued to work well into 2016. And even now, you could argue that in, let's say, in the post-OPEC cut world, European refineries, the more simple refineries that operate with the lighter crude, they might be having a small comparative advantage to the newer refineries because they are processing the lighter crude that is quite abundant in Europe, let's say Libya or from West Africa. So I think as soon as these kind of short-term factors abate, we might see even more of an acceleration of closures in the OECD, and especially Europe. Japan, as Kim pointed out, as well as Australia, have been shutting down capacity quite consistently. And if you add on top of that this 1.3 million barrels of new refining capacity that analysts expect, and I hope, Robert, that they are right in this, then you could have a good runaway for product tanker demand going forward.
Well, just to add, I mean, I agree with everybody. In case we see a higher oil price environment, I guess the closures of these refineries will accelerate, and I guess the demand, the export that these refineries will come from other places, such as the U.S. Gulf and the Middle East.
Gotcha. Robert?
I think what we're going to find is what we found in the dry bulk, what we're finding now in the dry bulk market, is that basically we're all underestimating demand. All of us are too scared to really sort of put our foot down and be really confident on the demand side. But probably we're seeing the economic development in the dry cargo. History would say that the product market follows reasonably quickly afterwards. And we're just all naturally, whether we're on this panel or out there in the audience or analysts, just a little gun shy to say, demand is really there, and what on earth happens if demand is actually higher. But the history would say that in the same way as GDP in an upswing environment starts to get revised higher on a quarterly basis, that's going to happen in product tanker and what we're doing demand. And with the rates where they are at the moment, because they are really kind of okay, the product market could gap very, very, very quickly. And once that happens, it's gone. Asset values too, because the asset values in a way are a force value, because no one on this table is going to conduct transactions at those prices. And stocks are trading well below their net asset values. As soon as those things happen, stocks will not just go up, but they will go up above their net asset values. So to me, you need to have a very healthy sense of conviction and urgency to keep positions on. So what we're trying to do in Scorpio Tankers is to maintain our operating leverage, to take situations where we can time charter ships in with optionalities going forward, and to, at the same time, to be responsible with the balance sheet by keeping up front of the curve liquidity against anything can happen stupid. But I really think that all this it's just going to move, because as Jakob says, if this is bad, fine, great.
Right.
It's not a bad place.
You know, Robert, I totally agree with you, and I would also like to say one thing. I think everybody has noticed how many companies today have been doing sale and leaseback transaction, which normally was not a very common way of disposing of ship. We've done our series of them. We're looking at a series of them, but mainly we did it under we're looking at it in two different ways. Way number one, and I think everybody else on this panel is doing the same thing. Way number one, we're kind of happy that we can dispose of all the tonnage and keep control of it for the next 3-4 years at reasonable rates, because we all believe that we're going to be facing a strong market the next 3-4 years. And for us, keeping ships in our fleet, keeping, like Robert says, operating leverage, I think it's an important thing. So welcome these kind of transactions. Second thing, we're doing them very much at market level, like everybody else has been doing them in the product tanker market. So nobody's just not trying to make money up front and then dish it out day by day on the reasonable charter rates. We're doing it at market level, all at reasonable TC back ends, and these are going to be assets contributing very heavily at the bottom line in the next few years. So I think this is another sign that we're all pretty confident of the market that's waiting for us in the next years. And starting, I think, mid-17 and for sure 18 is going to be a very strong market.
Also, the supply fundamentals look good. The new buildings and the orders are on very slow. So we think that, with all the demand kicking in and continuing, we think that it's going to be a very good market in the next couple of years.
Okay, good. And I want to get to that in 1 second, but before I switch gears to supply, Jakob, you said something that I wanted to follow up on, and you were talking about, how the demand for products tankers, is going to be good, kind of almost regardless of oil price environment, et cetera. But, you guys are in probably the best seat of anyone in this audience to talk about one topic that is always difficult for people to understand as it pertains to products tanker demand, and that is arb trading opportunities. So can you touch on the significance of arb trading opportunities to refined products tanker demand that have nothing to do with end user demand, but that are prevalent and relevant in a world where, maybe you're going to be seeing inventories coming down in certain regions but not others. And so can you talk about how that could affect products tanker demand?
Absolutely. So thanks for that question. So I think if we already touched upon that 2015 was a year with elevated rates compared to where they are today. Obviously, end user oil demand was lower in 15 than what we have today, and albeit we've had some deliveries, what drove rates, and in our case in TORM, we had rates that were 30-40% higher in 15 than what they were in 16. Even though the environment was more or less the same. And that was predominantly driven by the fact that you had arbitrage trades on top of the fundamental trades. And how much is that then? And how will we come back? Well, clearly, we need to see more of what was already mentioned here on the panel of destocking. Destocking is going to drive more stress in the system and more arbitrages coming up, whether it's the gasoline going into the US or the diesel moving the other way back into the continent from the US. Is all driven by arbitrage and by stress in sort of the cargo system. And in general, I think nobody will have, it's not an exact science, but on top of fundamental trades, we estimate internally in TORM that it's somewhere between 15 to 20% that is driven purely by arbitrage. And obviously, if you take this fundamental issue of, even if you imagine that oil consumption worldwide was flat, if you saw that arbitrage trades went up by 5 percentage points, that would still be driving your market.
Thank you for that. And Kim?
I'd just like to add that, tanker businesses, we're in a luxury situation actually, because nobody's really questioning the demand side, and you hear it on every panel that the demand is there. People are using fossil fuels still. And so that is not an issue. And if we skip the supply side for a moment, well, I'm sure we're going to come back to that, but it's the arbitrage side, and that is important because we need the ton miles. I think Jacob said before that we need all this ton mile to absorb the incoming ships. And arbitrage, what is that? It's differences in prices in two areas, and you ship long haul products because it makes sense, because it's cheaper in one place and more expensive in another. And one of my favorite slides is, 20 years ago we had trade lanes in the product tanker market. You could name 5 or 6 big ones, really big ones. And today, when all of us are making our presentations, we have trade lanes of 20, 25 potential trade lanes. And they are all there, but they are not necessarily there for 365 days a year, because these arbitrages opens and closes. And when they are closed, as I said before, the ships are being, bundle up in one area, and they're very soon open for a next cargo again, and that puts pressure on rates. Despite the demand is still there, but you have the ships being clogged up in one same area all the time. So that's why the arbitrage has an impact. And I wasn't aware, but did you say, Jacob, 60? How many percentage?
15 to 20%.
15 to 20%, and that's really the top margin, and that's what we really need to have working all the time.
And Robert?
Think of this in simple terms, right? All of us are sitting there saying destocking. Everyone is talking about destocking. So basically, that has to stop at some point. You can't keep going to the fridge and taking the milk without going to the grocery store at some point. Right. So that means that your actual headline demand without arbitrage is higher than what is being displayed right now. So if you stop the destocking, add arbitrage, God forbid you actually try and build your inventories back. Right. I mean, this is such an asymmetric trade. For you guys, it's untrue, because it's not like these companies are facing Chapter 11, etc. And why it's an asymmetric trade is it's sleeping there. None of us know the exact inflation point, but economics will tell you it's happening, and what's happening to the other markets will tell you it's happening. And simply, you guys woke up to the dry cargo stocks melting up from October in one direction over 6 months. That will happen in the product tanker market, except it'll take less than 3 months. You'll literally come in one day, MRs will be printing at 18, LR2s will be printing at 21. 2 weeks later, they'll be trading at 21 and 25, and then good night. They'll take out all the trade below net asset value. They'll move straight over net asset value. You guys will be as enthusiastic about them as you were this morning about in the last weeks in the dry cargo, and you'll have even less liquidity in tankers, in product tankers, than you had in dry cargo. So as investors, you should forget about what the spot market is doing, forget about what the analysts are saying, start taking positions in any of these product tanker companies, including Ardmore aren't here today. You don't have to go all in today, just keep buying on red days or along the way. Don't look at your VARs. Yes, every now and again they'll go down 5 or 10% on a day, just like the dry cargo ships. And one day you'll wake up and you'll go, thank God I did it. Rather than, oh my God, I need to chase this. I've missed out again. Okay? Okay?
Yeah.
Here.
Exactly.
And that's why we as insiders are buying Sting. Okay?
And Robert, to that point, that's why we dedicated 3/4 of our product tanker panel to discussing the demand side of the equation, because not only is it generally harder to get your arms around, but it has the biggest impact on where we're going from here.
And you guys know you want to do it. For weeks now, you're asking me, when's the inflection point? What's going to be the catalyst? When will we know the rates have turned? You're on the edge of the swimming pool. Some people are already there, like the big long onlys are already there. They're already buying. Jump in and join them.
No, and then, Robert, I think all of this has to be added to the fact that we're moving to an environment where there's going to be really very, very few ships delivered. And so you'll see this pickup of activity, and then normally it is not going to be eroded by a lot of ships coming in the market. That's why I think we need to be all very disciplined. There's a lot of resales. We should try to be very, very careful and not overbuilding in this market. We're looking at a fantastic picture on the supply side for the next 2 years, I think. One of the best ones we had in years to come.
Yeah, so in Jerry and Eddie, when you talk about the supply side, how did the order book get this small? I mean, given the attractiveness of the outlook, how did it get so small? How small is it, and how does it affect like your fleet growth expectations for this year and next? Just what are your thoughts on those high level supply side topics?
Considering that the past 2 years we've seen an order book in the region of 12% of the total fleet, this year we estimated to be in the region of 5%. And this is assuming that there are no delays and every vessel is delivered. Especially for the medium-range tanker that we follow, the supply picture is even better. So going forward, there have not been a lot of new vessel deliveries. Owners have been very reluctant in placing orders. And of course, the shipyard capacity fundamental has changed over the past years. The good quality Korean shipyards have become less and less over the years. And appetite for new buildings is generally very low, considering also the financial restrictions, if you want, in new building projects.
Jerry?
Well, I don't necessarily believe that there is inherent discipline in this sport, and I think all of us here sitting at this table have been at times responsible for order, or even if you want, over-ordering ships. That's the nature of the beast. But as Eddie pointed out, what I do like, especially for the MR product tanker space where we are most active, is that when you look at the actual shipyard capacity, and if you go through the shipyards one by one, the only real shipyard capacity for MRs out there, it's Hyundai Mipo. Back in 2013, we had SPP, we had Sungdong, we had STX, we had Daisan. Nowadays, SPP is closing down. Sungdong has sold one production line, and they have mothballed another. And by the way, they don't want to be in the product tanker, MR product tanker space anymore. Daisan is a very small shipyard that struggles to compete. STX has closed down and is expected to come back in one form or another, but definitely not what it used to be in terms of capacity. So even if we don't have the discipline, and as I said, I don't necessarily believe that the discipline is there unless there are other reasons into play, for example, lack of finance and so on and so forth, and people rushed into the shipyards on the back of the rate environment that Robert described, then again you would have very limited capacity, talking about 20, 30 ships a year in Korea. That will take at least a couple of years to deliver. So you could easily see a picture whereby the market could be good and very robust by end of 2019, early 2020, without even having deliveries start coming on.
Very interesting is to follow the older tonnage, especially for the MR sector, which we follow, and approximately 13% of the fleet of MRs is overaged, is in the region of 20 years old and older. And with the new regulations coming in the next years, and considering what Jerry is saying about the capacity in the shipyards, I think it's a very good story, because we'll see the fleet decreasing, actually.
Gotcha. And Robert, it looked like you had a thought on the topic.
No, I think that useful piece of analysis, and I know that it's inside Platou Clarkson's, right? Because I've seen it as an owner. Okay, what you want to ask is an interesting question here. Of the MR order book at its height in 2014, how much of that order book was ordered at yards that can no longer build product tankers because they've shut down? That number is a frightening number. That is your actual confirmation that it's going to be hard to build into this product market as it improves. The second thing is that the lenders are far more disciplined in this. The third is that you're a long way from the point where you're going to give capital to speculative new building orders. One day again you will, but the stocks will, by definition, be much higher than where they are. But these are the key things, is drill down on the analysts, not what present spot rates are, and let's prorate them forever and see what return we get. Ask specifically about the capacity of building product tankers, how it's changed in the last 2-3 years.
See, that's what I was going to have a follow-up question to that before I even introduce it, and that is, does anyone have a good estimate as far as how many MR new building slots came out of Korea 2 or 3 years ago, 100, 110, whatever, and how many are likely to come out in 2017, 2018 to kind of quantify that very point that Robert just made? Is it?
I don't have the figures, but I think this topic is clearly stated by Robert, so if you look at 2016, you had a new building ordering taking place that was a 20-year low. I'm pretty confident that we're going to have a 17 that will follow lead. And whether it's then at the same level or just around that, it's very, very constructive. At the end of this year, you will have an order book that will stand at 6% of existing fleet.
Right.
So these data points is just substantiating what Robert is saying, is that we have a market that will have legs. Once the demand side clears itself out, there's not a huge risk of an influx of just a lot of supply coming on. And clearly, financing institutions, whether it's the state-controlled in Korea and China or whether it's international banks, they have discipline, not because they want to have it necessarily, but because they are under certain regulation to clamp down on their vast amounts of lending into this sector. So this is really positive for the players who are already there, which is people around this table.
Right. And Kim, I saw you had
it's kind of a no-brainer if you start already. You have a segment where the yards who build ships in that segment are not that many, because also in the 2012-13, there were not that many the shipyards who were building product tankers. You have some of those yards closing. You have some institutions that are not going to issue reforming guarantee. This can only be better than what it was before. It's kind of a no-brainer. It's coming down all towards a certain direction.
And you're talking closing. We're not talking about private equity money going in and coming out. These are yards closing. These are people getting laid off. These are, how long will it take for that?
Most of them. Up to a certain extent, right? So you have certain shipyards that have closed, as I said, but and there is definitely, I think, a very long discussion in Korea as to how many more shipyards KDB and other financial institutions can bail out. But definitely, for the first time, you see actual capacity exit the industry, and I think that's the very positive thing that we haven't seen almost for 2 decades. And if you ask me, the demand has been always there. We know it, and maybe you are right. We have to make a better, maybe we have to explain it better, because we do see it in our trades. But what makes me very optimistic is the supply side, exactly because there is actual removal of shipyard capacity.
Kim?
Just to add on, and I agree with most of what people are saying. My first reflection on what you said, that the order book is down to a small number of 10%. Yeah, it's small compared to 20–30% that it was, but in a way I think 10% is just about the right size. With if the ships can live to 30, and you need 5% replacement and 5% growth, so maybe 10% is the right number actually. And I'm surprised, positively surprised over the discipline the last couple of years, like Jacob was saying. The order book is very, very low now. The new orders going in, I should say, I still think 10% is okay, but not too low. But the number of orders going in has been very, very low the last couple of years, and that bodes very well for 18 onwards. Even if I'm a little bit more cautious about the remainder of this year, 18 onwards, I certainly buy into all the arguments that's been presented already. So things are looking very, very good, I have to say.
Okay, good, great, thank you. And then we've got 2 minutes left, and through some of these topics that I introduced to you guys, I tried to hit on, what I thought would be some of the relevant demand and supply topics. In the final 2 minutes, I just wanted to ask each of you to kind of maybe throw out there something that I didn't think about that you thought was relevant. Is there anything that we didn't discuss that we should have that the audience may find useful? Robert?
Yeah, another confirmatory data point that we're at the low in tankers and product tankers is that DNB downgraded the tanker space today.
This morning.
They have a perfect record. It's perfect. It's the final, that's your final confirmatory buy signal.
I guess you should know, we're very positive on the product tanker segment, and we think the US will be increasing their refinery production. So I think this is a very good story, and this is what we try to communicate to investors.
Okay, excellent.
And And Doug, we have not even started scratching the surface of what kind of large regulatory changes are waiting for us in the future, and that's going to make
That's a great point.
That's going to make another hell of a difference in our market.
See,
we not even started talking about that.
Well, I was going to say I had it on my list, but I was trying to hit on some of the other topics in the interest of time. But Marco, that is a huge factor. So can you maybe give us a 1 or 2 minute kind of like rundown on that?
I think just very quickly, I think all who've been in shipping in this room say the big changes in markets have always been led by big regulatory changes. So look what happened during the single hull, double hull, and the next years we have at least one decently major issue, which is going to be the ballast water treatment plant. But the second huge one, which actually nobody can imagine, but I can only think about some solution, is going to be the low sulfur circulation in 2020. And I think that unless people go on scrubbers, which is still a new technology, huge logistical problems, I think most people will be burning more expensive fuel because it is with less content of sulfur. And who normally wins out when everybody's burning fuel and it becomes more expensive? The guy who burns the least is normally the guy who's a winner in that game. And I think at this table, a lot of us started very early doing eco ships, which were ecological but become also economical. So as I always say, I think we will have a good hedge there on the market, I think.
I'm glad you brought that up.
One really important thing here is that of course we're really excited as a group as what's happening in the dry cargo. We're on a private side with major shareholders of Scorpio bulkers, and that's got a long way to run. But what you guys have to understand in the product side is not a single one of these companies are on moratoriums from the lenders. And I would put a reasonable amount of money to say that a Scorpio Tankers earns $1 per share EPS before any dry cargo company earns $1 a share. And that's because the market is that balanced, and any improvement is going to go straight to you guys as shareholders. And that, I think, is being really ignored in this sort of angst about inventories and et cetera, et cetera.
Very good, thank you. And we have time for maybe 1 or 2 questions. No? One? One.
So it's a lady. Come on, be a gentleman. Come on.
Quickly. Yes.
I know you have a buy on the product market. I know especially Roberts and Ardmore with nice price targets. What is your view when the turn's going to be?
You know, that's a great question. Our view is that it's going to be this year, similar to the panel, and it could be in the next couple of months. I mean, literally the only thing we think that's holding the market back is this inventory overhang that everyone discussed. And as soon as that's worked through, whether it's through a heavy turnaround season in the spring or whether it's just through strong end user demand, as soon as that's done, all of a sudden, instead of taking inventories out of the ground, you're going to be shipping more product. And so that ought to correspond with whenever the order book starts to, the deliveries really start to slow. And so I think it could literally be in the next couple of months.
Yep, I agree with you.
Sounds good.
Yep.
All right.
No,
great. Well, thank you for that, guys. Thank you for the time.